So, hey, I'm really excited tonight because we have a special guest. My friend John Chang is going to be on. I know John is here, but the way we're going to go is I'm going to speak first for maybe 15 to 20 minutes. And then I've asked John to speak for around 30 minutes. And then I'll finish up the last 15 minutes. So we should be on for plus or minus an hour. So around 5 minutes after the top of the hour, depending on where you're from. I'm in Dallas right now. So we should be done, say, between 7:05 and 7:15 Central Time. So I just wanted to let you know what to expect. And I'm going to cover some slides here. But the whole gist of tonight and why I'm excited is there's a lot of things going on that are creating some uncertainty. Things at our federal government level, you know, the announcements of tariffs and integration reform and what's happening in Gaza and what's happening geopolitically with Russia and Ukraine and you know, our president announcing that we want to take over Panama and Greenland, and it's just creating a lot of uncertainty. I see some of you smiling there. And also, look, it's the times of the biggest uncertainty that create the biggest opportunity. And so I'm going to share with you what I'm excited about and where I see opportunity. And then John is going to do the same thing. And John is a senior vice president at Marcus Millichap, the country's largest, or definitely one of the largest commercial real estate firms. And his team and John, they have vast resources and vast amount of data. And so John has a very unique perspective about all this type of stuff. So John, if you could just say hi to everybody, and then we'll be back with you in around 20 minutes. So John, welcome, and it's good to see you. And just give everybody a 1-minute teaser about why they should stay on and wait for you.
Oh, wow. You know, Brad, as you said, thank you for the introduction. But as you said, there's so much uncertainty. There are so many things happening right now. It's really hard to keep track of it all. So I'm going to try to take all that information and distill it down into what it means for multifamily investing and what you can look forward to over the short and the long term. So those are the key things I'm going to focus in on.
John, let me just ask you a question. Do you see some interesting opportunities for people that are ready?
Oh, yeah. And it's all about perspective. And so you have to look past all of the short-term headwinds and understand the long-term drivers of multifamily, and it can help you really put things into the right perspective to make long-term investments like this.
Well, I'm excited to have you. I have my notepad right here on the table, so I'm going to be taking notes when you're speaking as well as everybody else. So, John, we'll see you. And I tend to be a little long-winded, so I say 20 minutes, maybe 30. But
hey, we've done this before, Brad. I know how you are.
You know how it rolls. But it's just me and you tonight, and so we don't have a hard stop at the top of the hour. So, all right, I'm going to do my introduction. I'm going to cover a few things and bring you back on, and it'll be interesting too, when you come on, if you have a chance to listen to me, to maybe give a few comments to what you heard me say as well.
Yep, happy to do it.
All right, thank you.
Sure.
All right, everybody, super excited. Hope you guys are excited. So let me just ask you, what are you most excited about that you think we're going to hear about tonight? Just drop it into the chat, what you are most excited about before we go into what we're excited about. So I'd love to get a read on all of you that are participating tonight. So drop in the chat something that you're excited about right now about the opportunity in multifamily investing. So let's see, we have opportunity, bonus depreciation, discounts, anything else? R to R, yeah, that's my event coming up. Yes, I'm excited about that. William Kurtz, you guys teaching us how to get into multifamily, capital raising, interest rates with a question mark. So John, we could see some of the things that people were excited about too. And then the next question is, Well, I'll stop asking questions because hopefully we'll give you a lot of insights tonight. And then at the end, if there's time, we'll do some Q&A. So these are what we're going to talk about tonight. The first test I already failed. And if you could see on the slides, it says 4 things we're going to talk about, but there's 5 bullet points here. So I actually just added one in 5 minutes before we started. So for those of you that have not heard me speak yet, maybe you came here through a Facebook ad or a friend invited you, I'm going to do a short intro about myself and who's this Brad Sumrok guy speaking to you tonight. Then I'm going to share at a high level why I'm optimistic right now. I'm going to cover the top markets, and I have some specific data about DFW, and I'm also going to talk about the Texas Triangle, and then I'm going to talk about how to capitalize on the opportunity. And then in between there somewhere, I think somewhere between points 2 and 3 is when I'm going to bring John in. So again, I'm going to cover a few points. John's going to speak. And John, when you're done, I'm going to dive into some of your slides actually from the Marcus Millichap annual report to go into DFW. Unless you already have that in your slides, then we won't cover it. But I have some of that as well. So let me go ahead and get started. So for those that are new to me and hearing me speak, I just want to share that what I've done is something that I believe anybody could do, because just like many of you, I started with no previous real estate investing experience. I have an engineering degree and an MBA, and I was never taught by my parents, or I never had any business mentors or business coaches until I was in my mid-30s, and my path was corporate America. So I studied hard, got good grades, went to the university, got an engineering degree, wanted to climb up the ladder, got an MBA, wanted to climb up the ladder again, end up getting laid off once, fired once, got really frustrated. And I picked up the book, Rich Dad, Poor Dad, where Robert Kiyosaki talked about passive income, being a real estate investor. And then in his second book, The Cash Flow Quadrant, he made distinctions between 4 ways that people view making money. And one of them is being an employee, and the other one is being self-employed, and the third is being a business owner, and the fourth is being an investor. And so what I love about multifamily, especially larger multifamily buildings, is we could buy a business. Okay, everybody probably heard of Marcus Millichap, the prophet, where he buys a business that's not doing that well, and then he turns it around. And essentially, this is what we do with multifamily buildings. We buy businesses. I've never developed a property. I buy an existing multifamily building, whether you want to buy 10 units, 50 units, 100 units, or 300 units, whether you want to buy an A class, a B class, or a C class. What I teach works in just about any of those scenarios. And so we buy this building. It's already built. It already has tenants. It's already running. It already has an income stream. And we just make it run better. We make it run better by maybe changing the management, maybe doing capital improvements, usually a combination of the two. And we can improve performance, improve rents, improve occupancy, optimize expenses, and make the property more valuable. So I started buying my own deals with my own money. And then when I ran out of money, I actually, by necessity, not by choice, was forced to syndicate a deal. Now, I don't mean forced at gunpoint. What I mean is that I bought 62 units with my own money, and then a broker from Marcus and Millichap brought me, John, back in 2005, a 250 unit deal, and all my money went into the first 2 properties. And fortunately, I was going to real estate events, conferences, masterminds, meetup groups, and I was building up a contact list, an investor database. And so my third deal was 250 units that I funded mostly with other people's money, hired a property management company, and I found that 250 units was easier for me once I closed it than the 62 units, because the 250 units I was able to hire a professional management company. I was able to get a better loan, a type of loan called non-recourse from Fannie Mae, which means I have no personal liability. So since then, after buying my own properties, 62 units, I've done over 11,000 units as a general partner. General partner is also referred to as like the active investor, where I find the deals, put the equity together, secure the debt, and oversee the management. So I've been doing this a long time, 22 years, going on 23 years. And one of the things I learned from Tony Robbins over these 2 decades is to observe patterns. And history tends to repeat itself. And to me, where we are right now kind of reminds me of like 2012. 2012, we were coming out of the great financial crisis. People were nervous. Some people lost money in 2008, 9, and 10. The cost of debt was relatively expensive. Equity was nervous. It wasn't easy to do transactions. And there weren't a lot of transactions happening. But boy, the transactions I did in 2012, the biggest mistake I made was not doing more of them. In fact, I don't know anybody in 2011, 12, or 13 that says, you know, I wish I would have bought less real estate. Everybody I know back then says that they wish they would have bought more, but it wasn't easy to put the deals together. So that's where I think it is now. We're starting to see more transactions come online. Sellers need to sell. You know, we had a few rough years and sellers delayed selling their buildings as long as they can. But now many of them are in a situation where their loans are coming due, or they need more CapEx and they don't have the funds in their company. And so they're faced with a decision to sell. Okay, so we're starting to see more transactions hitting the market, and we're seeing more of a buyer's market than I've ever seen before. So besides my individual accomplishments, I've created a community that's known as like the Sumrok program, or the Sumrok community. And I started this in 2013, and I'm really proud of what my clients, that I also refer to as students, what they've achieved. And they've bought literally hundreds and hundreds of apartment communities all over the country. The last time I added them all up, it was literally over 100,000 apartment units and $7 billion worth of multifamily real estate. And lots of them have made themselves and their investors lots of money. So that's a little bit about me in a nutshell. And I continue to do both. I do events, I do free events, I do weekend events for a couple $100, and I have 1-year programs that are in the $30,000 range, where I hold your hand every step of the way. And I still am involved in lots of transactions and acquisitions on the general partnership team. So that's what I do. And that's what I've done for the last 22 years. And that's what I'll be doing for at least the next 10 years of my life. And I'm excited about what I see right now. So again, I've been doing it 22 years. I would love to say I have it all figured out, but honestly, I don't. I continue to learn. I go to conferences. I listen to people like John. I was at the NMHC event. I was at the Miami IMN event. I continue to invest in conferences, in seminars, in masterminds. I continue to learn. I continue to spend time around people at and above my level so that I can learn from them inside the industry and outside the industry. I'm involved in a mastermind that's exclusively with 8- and 9-figure business owners, and it's not even a real estate mastermind, but I learned from, people doing 8 and 9 figures a year. And so like literally I've spent millions of dollars investing over 2 decades, investing in my own education outside of the formal university system. And I think that's part of why I've had business success. So we all know that we have a new president here. This was a picture right before the election. I never saw this slogan before. It was always "Make America Great Again." But a few weeks before the election, they came out with a slogan said, "Trump will fix it." And I'm thinking, fix what? Well, I guess fix maybe some of the messes that were created. And so one of the things that excites me is we have 2 years where the executive branch and the Congress are the same party. And then, of course, the judicial branch is by and large mostly conservative. So all three branches of our government, what occurs to me is that we're in alignment. And so even though they're bickering about the budget and all that type of stuff, I think the next 2 years, we're going to get a lot of things done. Now, is it going to be good things done, or is it going to be not so good things done? And some of those things I think are going to be good, and some we're not sure about. But the American people will go back to the polls in 2 years, and we'll have midterm elections. And then they're going to decide, we as the people will decide, do we like the way our country is going? And if we don't, we can have an executive branch that's Republican and a Congress that's Democrat, and then we could be back in some gridlock. But to me, what really excites me is the powers, the parties in charge right now seem to be more pro-business and how that's going to benefit us as real estate investors. And so this is a slide that shows that we have a red presidency, a red Senate, a red House, and a conservative Supreme Court majority. So I think a lot of things are going to get done. Speaker Johnson, I know, is working on, not like I know personally, but when you read the headlines, they have a version of a budget and a tax cut extension that has been passed in the House and one that's been passed in the Senate. And so in 2017, they made multifamily buildings one of the best tax advantage asset classes in my lifetime, bringing back bonus depreciation. And when I talked to my friend Tom Wheelwright, it looks like they're going to bring that back either permanent or extend it for 5 years. So one of the things that I'm really excited about is, look, I haven't paid federal tax 2018, 19, 20, 21, and 22. For 5 years, I didn't pay federal tax because all the money I made from my buildings and my capital gains and from my event and seminar company, I reinvested in multifamily buildings and got so much depreciation that I didn't pay any tax for 5 years. So I'm excited about that. So I just want to check in with you guys and gals. Who's excited about the opportunity where apartments once again could be back to like the 100% bonus depreciation? Anybody besides me that is excited about that? I see at least one person. Okay, I see a few of you. Okay, good. I'm excited about that. So I think that's coming. What I wanted to do, John, before I brought you on is also just quickly talk about like the top 10 things I'm excited about. And one of them is, it occurs to me, if you look at number 1 and 2, I believe we're kind of at the bottom of a cycle. I don't know for sure. I could be wrong. But when I look at the patterns and I look at where we were at with pricing and cap rates and where we're at now, I think real estate's on sale. We're at the bottom of a cycle. The number of new multifamily development projects that are starting is at a 10-year low. There's a huge demand for multifamily housing and a huge shortage of housing. It's harder and harder to buy a home in America. John, I saw your slide that you presented that like only, and you know, if you have it, show it, but like only 27% of American households could qualify to buy a median priced home in terms of getting a loan. It's crazy. And so what are the other 73% of working and middle-class families going to do? They're going to rent in your apartment building as long as you get into the business and take action. As a buyer, I have not seen the competition this low in more than a decade. It's a buyer's market. And what that means is because there's less buyers, I mean, there's less people buying right now because people are on the sidelines. Those that are taking action can negotiate better prices and better terms. I already talked about the tax benefits. I'm sure we're going to hear about we're still in a recessionary environment, and that actually favors capital going into real assets. And then I'm sure, John, you'll also talk about transaction volume. And if you don't, you know, maybe we could talk about that a little bit, but from your team nationwide, and I'm connected with a lot of your teammates that run investment sales in different markets, and I met a lot of them at NMHC, we're seeing more and more deals hitting the market. So lots to be excited about, lots that I'm excited about. And I think this is going to be the year where together, those that join me are going to make apartments great again. So, John, I think this is where I bring you in, but let me just check my slides to see if I missed something here. Oh, one more thing. And John, I'm going to do this now before I bring you on, because I actually have a very captive audience. I want to share with people the opportunity to come to a training event that I'm going to do in April. It's going to be in Dallas. I've done this event 3 times a year since 2013. It's a 2.5-day training event. We begin Friday afternoon. I teach Friday evening. We have a networking event Friday night, and then we go all day Saturday and all day Sunday. And we're going to go on buses one of the mornings, and we're going to see a property in Dallas that I own, and we're going to see one that one of my mentees owns. And so all this is going to be going down the afternoon of the 25th, which is a Friday, all day Saturday, all day Sunday in Dallas, Texas. And what I teach is the process that I've been doing for 22 years. I teach how to find deals, how to analyze deals with the numbers, the financial analysis, the underwriting, the market analysis. I teach how to fund the deals, how to raise the money, secure the debt, how to close the deals. And then once you close them, how to do the value add, CapEx, the KPIs that you should be managing and tracking. And we'll actually be teaching different exit strategies, whether it's selling, refinancing, recapitalizing, or where some of my mentees are now, or it's like doing loan extensions and stuff like that. So it's all going to be going down April 25th, 26th, and 27th. And so if you take that QR code, the first 50 people that buy tickets are going to get $100 off. And I could just tell you the pricing is very inexpensive. It's $100 for a general admission ticket and $300 for a VIP ticket. And if you scan that code or take a picture of it, the first 50 people that secure their ticket are going to get the best available early bird pricing. So John, that's my part. I'm going to bring on John, everybody, and then I'm going to finish up. And once John is done, I'm going to go into detail in Dallas, Texas, Fort Worth, Austin, and Houston on why the Texas Triangle is one of the hottest markets in the country. So John, take it away.
All right. Well, we're going to load up our slides here and get that up and running for you. And but yeah, there's a lot going on in the multifamily space. There's just so many key trends that are shaping the market. There's a lot of uncertainty right now. As you mentioned, there's a lot of short-term headwinds, and I'm going to walk through all of those things and talk about why multifamily still looks very appealing despite some of the challenges that may be out there.
Hey, John, I wanted to let you know too, I'm inviting some of your DFW investment sales team to my conference to be on a panel. So I'm inviting folks from the Llewellyn Group and the Silva Group to be at this conference so they could maybe feature some deals for sale as well, so that the people in the audience will be able to look at buying opportunities.
That'll be fantastic. Those are some of our best brokers in all of Texas, and they really know the market very well, and they have a lot of inventory. So that should be a nice match. So fantastic. Thank you. So let me just dig right in right here. Can you all see my slides? Is that up there? Good. Okay, fantastic. So the biggest economic wild card for 2025 is, of course, the new Trump era, and this came out in January from Oxford Economics, and it has really come to pass as they said. This was definitely a period of uncertainty that we're navigating right now, and as you said, Brad, that has some opportunity attached to it. And it also creates some headwinds and some challenges. So I'll get into that a little bit here. When you look at the uncertainty index, it is at the second highest level on record, right behind the pandemic. And that's being driven by a variety of things, as you mentioned. We have tariffs, we have immigration reform, we have a lot of issues globally. So these are all contributing to that. And normally, when you have high levels of uncertainty, and we saw this in the pandemic, we've seen this when we've had government shutdowns, we had it during the financial crisis, people step back, they wait, they move to the sidelines. And again, what that does is it means that there's less competition for assets, but at the same time, there are investors who need to sell their properties today, so the inventory is still there. But it's also causing concerns, right? So when you look at some of the headlines we're seeing today, this one came out a while ago, but it's still true. The Atlanta Fed modeling shows that economic will run negative in the first quarter. There's a lot that goes into that, right? That's the headline, but what's behind that is basically because of the tariffs and the risk of tariffs, a lot of companies were doing extra imports at the beginning of the first quarter. And when you have more imports than exports, that is a negative impact on the GDP. So basically, you get a negative number because we imported so much in the first 2 months of the year that we're going to drive our GDP negative. Now, that could bounce back in the second quarter. There's still a lot of other variables out there, but there is a little bit of story behind that. When you look at the GDP growth forecast, the consensus blue chip forecast right now is about 2%. We have seen some revisions from major economists, Goldman Sachs, Morgan Stanley, both recently revised down their forecast for the year from about 2.3, 2.4, 2.5 down into the mid 1% range. But that is still growth. And historically speaking, even if we hit a 1.5% growth rate, that's fine. That's enough to support the momentum, especially in multifamily. And there's a variety of reasons for that as well. When you look at what's happening with some of the other metrics, job growth has been tapering. That is by design. The Federal Reserve is purposely moving job creation down in order to reduce inflation risk. We still have a labor shortage. We still have more job openings than we have people looking for work. And the unemployment rate is still at 4.1%, which is basically full employment. Now, we did the math, and even if we had all of the Doge layoffs that were in process, and those don't look like they're all going to happen at this point, but even if they did, that only moves the unemployment rate by 20 basis points. So it would take it to 4.3%. Which is still exceptionally low. Anything below 5 is considered to be low unemployment. So the employment market is still sound. When you look at other metrics like the manufacturing index, the services index, retail sales, small business optimism, they're all pointed in the right direction. Now, it's not shown on here, but one of the things that's catching a lot of the headlines right now is what's happening with consumer confidence and consumer sentiment. Those have been falling very, very aggressively, and they are tied to household formation. So I'll talk about this a little bit later, but essentially, they can be volatile. And the mix in the news right now is creating a lot of uncertainty. Basically, there are so many things happening all at the same time. It's hard to get your hands around it. That spurs uncertainty. There is certainly some recession risk, but as you said, Brad, real estate is one of the best places to be during a recession. They always say during recessions, you want to be in hard assets like real estate. When you have inflation risk, and there's more inflation risk right now because of the tariffs and because of the immigration standards that are being applied, that inflation can create headwinds for the economy. But again, multifamily is one of the few assets that moves with inflation. So you're marking the units and the rents to market every year on the leases. And as a result, it is one of the few assets that can keep pace with inflation over time. So these are all headwinds from an economic standpoint, from a perception standpoint, but there are safe haven investments that are focused on during times like this, and real estate is one of them. So just bringing that all together, I mentioned inflation. It has been ticking up over the last couple months, and it's at 2.8% for the headline number. Core PCE, which is tracked by the Federal Reserve, is still about 2.5%, which is a healthy place. It had been trending lower. But tariffs, if fully implemented, and I'm talking about 25% on Canada, 20% on China, 25% on Mexico, and so on, tariffs could push up inflation by about 0.5% this year. If you have significant deportations hitting the targets that the Trump administration has put out there, that could raise inflation considerably over a 4-year span. The impact of that would probably be more in 2026, 27 than in 2025. So that's not a real risk over the short term, but over the longer term, it could be. And as a result, because of the inflation risk, because of the uncertainty, the Federal Reserve has pulled back on its strategy of reducing rates. We had a 50 basis point reduction in September last year, followed by a 25 in November, another 25 in December. But they've held flat. They held flat last week. It basically saying, hey, we're not sure what's coming down the pipeline to us. We don't know exactly how all of these policies are going to actually be implemented. And so until we have more clarity on what the policy will be and what the policy plan is, we're going to basically step to the sidelines. We're going to hold things where they are. They're in a pretty good balance right now. The 10-year Treasury is around 4.3%. That's down a bit from where it was. It's high compared to what we were used to in 2020, 21, 22, but it is down a little bit, and it's right on the cusp of where investors want it to be. I've heard many of them say, if we can get it down to 4% or a little bit under, that would be perfect. That would be great. We're close enough that the gap can be covered through value creation, as you were talking about earlier, Brad. The ability to go into an apartment investment, roll up your sleeves, and find ways to create value can close the gap between the cost of capital and the return on the property pretty quickly, depending on the property. Now, many on Wall Street are still predicting rate cuts this year. My belief is that we're going to be looking at probably one rate cut in the second half of 2025. And depending on how tariffs play out, that may or may not come off the table. So that's what we're looking at. We expect the 10-year Treasury to be range bound somewhere between 4% and 5% through most of the year. So that's the interest rate outlook as far as we can see it now. Again, there's a lot of volatility. There's a lot of uncertainty. Any given day, something can change. We've seen that time and again over the last couple months. A new executive order comes out and it can change the calculus on a lot of these metrics. So for me, it's a day-to-day operation. I'm scanning the news every day to try to keep track of what's going on and really provide whatever insights I can based on the news of that week. Now, I said earlier when I was starting in, we have short-term dynamics that I just talked about. A lot of that is economic. And then there are long-term drivers. And I really believe that ultimately for multifamily, the long-term drivers are really strong. We still have a housing shortage in this country. Even though we've built record apartment completions over the last 10 years, we're still in a shortage. We've been treading water against household formation. We have not been able to make any progress. The estimates say that there's somewhere between 3 and 5 million housing units shortfall based on what the needs are. So even though we're building a lot of apartments, they're not keeping up with demand. And I'm focused here. This is the number of people for each age currently. And you can see that there's that big bump in the people in their 30s. And this is the millennial generation that I've scoped out here, 73 million of them. The median age of marriage right now is 29, and 29 is basically when people get married, that's a life change that often forces a change in the housing situation and the lifestyle. And I have the first home purchase is at 38 years old. Now, it's really important to note here. Today, the median age of a first-time home purchaser is 38 years old. 2 years ago, it was 36. In 2020, it was 33. In 2010, it was 30. So people are delaying. They're delaying marriage and they're delaying that first-time home purchase. There's a lot of factors in there. Part of it is quality of life and lifestyle. Part of it is the price of a house. Part of it is the interest rates. But nonetheless, that is being pushed back. And as a result, people are staying in apartments longer than they used to. And that's building retention of a millennial generation that has a huge peak right in their 30s. And then it's also, we still have the Gen Z coming of age and entering the housing market, people who are 22, 23, 24 years old, going out and renting their first apartment. So the momentum for housing demand is specifically rental housing demand is particularly strong and likely to remain in a really good zone for the next 5 to 10 years. So that's kind of the window we've identified for this outsized performance for multifamily is 5 to 10 years. So that's one of the long-term drivers. Here I have that graph that Brad mentioned earlier, which is the spread between the median home price, the payment, a monthly payment on a median priced home, and the average rent in the United States. And that spread is about $1,300. It's about as wide as it has ever been. And again, part of that is the record high home prices today. And part of that is that interest rates and mortgage rates are elevated. They're somewhere in the 6 to 7% range. And as a result, only 27% of US households have an appropriate income to qualify for a loan under the Freddie Mac underwriting standards. It's basically the ratio of income to payment. And so it's really limited. Historically, it used to be around 50%. Now it's about 27%. And again, that's going to build retention of renters. We're seeing this trend already manifest. The renewal rate is back up to 55%. It did peak as we were coming out of the pandemic at 57%. It troughed in 23, 24, and now we're on the upswing again. And part of that advantage is that lease renewals generally have stronger rent growth than new leases. You don't have the concessions. You're not trying to bring somebody into a unit. You're working off of where you started and you're raising rents from there. So the rent growth on the renewals is outperforming, and we're seeing the renewals increase. I expect that to continue to rise over the next 2 years as we grapple with uncertainty driven by the politics and the federal policy, but also as the home ownership remains out of reach for so many. I don't see anything materially changing there. If you look at not only multifamily construction is way down, as Brad talked about, so is single family construction. So we're simply not building enough houses to make a market for single family home sales, which means the home prices stay elevated. Interest rates don't look like they're dropping anytime soon. So I do expect the renewal rates to continue to trend upward over the next couple of years. On top of that, we have a lot of households that are bundled, basically young adults, people between 20 and 34 years old, who are living with other family members or are doubled up in some way. And that actually, it started to come down in 2022. We had a good level of absorption of apartments and household formation in 2022. And then it swung back in 23. And we've seen all those houses doubled up and the people living with family members. And that is pent up demand. So it basically builds up, and then when the right combination of events occurs, they debundle, they move out on their own, they create a new household, and that spurs high levels of absorption of multifamily units. So that's an opportunity. When you look at migration patterns, they favor the southern United States. They've been favoring Texas. They've been favoring Florida. If you look at just 2024 alone, you see a lot of strength in the Carolinas as well as Arizona. Those markets have stood out over the last year as the destinations for relocation. So that's why Brad focuses in on Texas, is because, or one of the reasons is because it is a destination where you're creating a lot of jobs and you have people moving there, which spurs demand for multifamily housing. And again, other markets that are top of mind include Florida, the Carolinas, as well as Arizona, Las Vegas, and Salt Lake City, Utah. All generating outsized demand. So I did break down into the 4 main Texas metros, Brad. So here we have the job creation and the unemployment rates. And again, I bring this up because these markets are some of the job creation leaders in the U.S. every year. And you go back into the early 2020s, and they were particularly strong. They were off the charts in Dallas, Houston, and Austin. San Antonio tends to lag a little bit behind. But like the rest of the country, the pace of job creation has tapered over the last couple of years, but the unemployment rates are still very low from a national standard. So the momentum in these markets remains strong. When you look at the completions versus the vacancy rate nationally, you can see that in 2024, almost 600,000 new apartment units were completed in the United States. We overdeveloped, quite frankly, because you have a 2-year lead time on these developments. So the things that were coming out in 2024 were being started in 2022 when the market was really performing well. You can see the vacancy rate hit a record low in 2021. The developers all got active. They started building all these apartments. They went gangbusters. Markets like Austin, Dallas, Phoenix, the Carolinas, Nashville, really got a lot of new units added over the last couple of years, but it is subsiding. We're over the hurdle. 2024 was the peak of the market. We're looking at about a 25-30% drop in the number of completions from 2024 to 2025. Still a really high number, 410,000 new units coming online in 2025. I saw a lot of you were from the Phoenix area. Phoenix, you may know, has a lot of units coming online, actually more units in 25 than 24. But that's not true for every market. Basically, most of them, it's starting to settle down and come off the backside. Now, we had really strong apartment demand in the second half of 2024. Consumer sentiment was actually surging. We had good job creation. The sentiment was really strong. The uncertainty levels were quite low. And we saw the demand for apartments, the absorption, hit near record levels, right? So in 2021, that was probably the best year ever on record. We got to the same type of level in the fourth quarter of 2024, where it was actually outpacing a record number of new units that were coming online nationally. And so the momentum has been really strong as we came into 2025. Again, looking at the metros across Texas, Austin, I mentioned that they overbuilt. The vacancy rate shot up. It's up in the 7s. Historically speaking, it was more of a 5.5% vacancy market. You had a big upturn in Dallas because of all the new units, San Antonio and Houston as well. Houston pulled back on the construction earlier and a little more aggressively than some of the other markets. And so Houston looks like it's going to be strengthening a little faster than Dallas and San Antonio. And Austin is going to be the laggard of the four metros in terms of fully absorbing all the units that were built. But the thing is that construction is tapering. Okay, so first of all, it's hard to get a construction loan and the rates are really high right now. So basically the builders are looking at it and saying, man, the cost of capital is too high. It's hard to build at that rate. The material costs were already elevated last year, and that was pushing a lot of the developers out. And if tariffs go into play, they're already on steel, they're already on aluminum, I think they're already on lumber, and basically half of the lumber that we use in construction is coming out of Canada. That has a significant tariff. 25% of the steel and the copper and the cement is imported. The materials that are used in drywall are largely coming out of Mexico. So the cost of materials were already high and they're going up. The cost of construction labor is already high and it's going up. About 35% of the labor force that builds houses and apartments is non-native born Americans. And if you stack in any of the labor that may not have been legal, it could be anywhere up to about half of the labor. And with tighter immigration standards, the number of people available to do construction work is going to be reduced over the next couple of years. And as a result, labor costs on construction are going to rise as well. So as a result, and this is for Texas here, and it's true nationwide as well, actually. It's pretty much almost the exact same graphs. But the number of apartment starts peaked in 2022 and is down dramatically. We're actually moving into a trough, lower than we've seen since basically 2010, coming out of the financial crisis. So construction starts in Texas down 78%. Apartments under construction, the number of units under construction in Texas down 47% compared to the first quarter of 2023 when that peaked. So basically, the competition, the new supply pipeline is thinning very quickly, and it's not going to revive over the next couple of years because of the costs associated with building new units. And you know, anybody who's had basic economics understands that when you start to shrink or control the supply while the demand, driven by the demographics I was talking about earlier, is on the rise, you get into an undersupply, and that pushes your vacancy rates down, and that pushes your rent growth up. So yeah, we have a lot of headwinds over the short term and a lot of things that are causing people to move to the sidelines. But when you look out 1, 2, 3, 4, 5 years, the momentum is really solid. And that's the opportunity that's real estate and apartments, and specifically apartments, represent, because it's not a day-to-day thing. You don't trade it like the stock market. You buy, you hold, you invest, you create value, and you have to think out 1, 2, 3, 5 years, sometimes 7 to 10 years for some investments in multifamily. And so it's the ability to look forward that is so important in framing your investment strategy. Again, Texas area rent and rent growth.
John,
Yep.
can I interrupt?
Absolutely.
I didn't want to, out of respect for all the amazing information, but there's something you said I just want to share with you and everybody else. I bought a property in 2015 in Columbus, Ohio. And, every year I do a forecast on where the best markets are. And most of the best markets for the past decade have been in the Sun Belt, but I always try to feature a few markets that are like sleeper markets in other areas in the Midwest and different parts of the country that are also, really good. So we bought this property in Columbus, Ohio in 2015. On I'm one of two general partners in the deal, me and another student of mine. And we refinanced it 2 times already and already got all of our equity out and cash flow. And then we just sold it 2 weeks ago. And the $100,000 investment that I made, I already got all the money out. I've been cash flowing at 10, 12% a year. And we just sold it after 10 years and I got 403,000 in sales proceeds. So
That's
like,
fantastic.
it's like the message that I have for those of that got into the business, there's 3 types of people that I'm talking to tonight. One is those of you that have been in the business, and especially in my community for more than 5 years, you know that what's happened the last couple of years is just a market correction. Tony Robbins says this, Ray Dalio says it. I've heard Ray Dalio speak 7 times at Tony Robbins events. He's a billionaire that manages $160 billion. Every asset class will go through a correction every 10 to 15 years. And we've had 2 in my 22-year career, one in 2008, 9, and 10, and one in 2023 and 2024. So John, people that have been in the business for more than 5 years, they understand this. The new people are excited because they see all the opportunity. But what would you say to the people, probably about half the people on tonight, that already got into the business, but they've been in the business for like, 12 to 27 months. They've had some challenges. What would you say to those folks?
There's a lot to be said for timing. We've gone through a challenging cycle. It has, we had a reset. We had interest. If you bought just before the interest rates went up, and actually vacancies went up and rent growth went down, that it was a very, very challenging time. My response is hold on, okay? Because I just shot a new video. It's going to be on my LinkedIn next Tuesday, and I just recorded it yesterday. And I said, look back 5 years, right? This is a long-term game. This isn't a short-term game. This isn't like investing in the stock market. This is a long-term plan. And so if you rewind the clock, I closed on a property in April of 2020, right as everything was shutting down. Pandemic was hitting. Uncertainty was through the roof. It was scary. My wife was freaking out. She's like, what if this doesn't rent? What if we can't fill these units? She was really upset. And I was like, look, our basis is low. We put a large down payment. We're positioned to weather any storm. And just remember, at some point, COVID will be over. So we bought in, we closed on the deal just as COVID was hitting. We leased it up. Everything was fine. We went through COVID. We went through the stimulus checks. We reopened. We had supply chain problems. We had massive inflation. We had rate increases. We've had a lot of challenges over the last 5 years. And at the end of the day, that property that I closed on doubled in value. It's worth twice as much today as it was when I bought it. Where rent growth is fantastic. It's cash flow positive. So don't lose faith, because you're taking your licks early, right? You've had a tough time over the last year or two. You got in, it looked good at the time. We went through some choppy waters, but this is a long-term game. And when you look at the graphs I have here on the screen right now, right? Those orange lines, and I know it's hard to see, I apologize for that, but they're jumping up and down, and there's good years and there's bad years. But look at the trend of the blue bars. They may go down for 1 or 2 years, but they trend up over the long term. And that is what we're talking about here. That is the momentum of the market that will carry you forward. And if you look again, it's those rent growth numbers over the long term are beating inflation. And we have some recession baked in here. There are some headwinds, there's some challenges, but over the long term, these properties outperform, and those rents trend up over time. So, long-winded answer, Brad.
Hey, that's great. That's great. Yeah, it's like I've started in this business, made the decision to get into the business in 2001 by going to a real estate investing seminar, bought my first 32 units in 2002. And so I've been in the business for 22, 23 years. And I would say 18 out of those years have been good.
Yeah.
And it's been a couple choppy years. And so, like, this is where I want to share with everybody that, like, every year is not going to be an incredible year. But because I've learned to, and John, you've been in this business for a long time as well.
Yeah.
We could recognize patterns, and not only recognize patterns, but we have the data. So when we look at the patterns and the data, what we see is opportunity. That's why I'm so glad to have you on tonight, because we see the opportunity. And the thing is, I think that most people on see it too, because the people that don't see the opportunity, they're not here. They're not here. They're like, oh, here's Brad Sumrok again, talking about all the opportunity. This is a terrible time. But there's a few folks on, a couple hundred folks on tonight, and there's several hundred more that registered that will get the recording. So, yeah, I think it's a great opportunity. I'm underwriting deals with my team, and I'm in action right now. Like, I'm in action, and I want to buy, as a GP, 3 to 4 transactions this year, totaling about 1,000 units. That's my personal investment goal for the year.
Well, I think that again, we're going to have a lot of choppiness this year. Don't get me wrong, right? I'm concerned about consumer sentiment. It dropped over the last 2 months at an incredible level. And I'm worried about the pace of absorption. But all of those households that don't form this year will debundle next year or at some point after that. So eventually it comes to the market, right? You can put up with having, living with your parents for a certain amount of time, but at some point you're going to move out. And that's the housing model, and they're not building enough. There is a shortage, and that is why this makes so much sense. So again, anybody who got into the business 18 months ago, two years ago, kind of the height of the market in 21, 22, then went through the choppy waters, don't lose faith, because the long-term trends play through. I'm just looking here at this graph, and I have San Antonio up there, and the rent growth there has been poor. But San Antonio is going to be a great market. This is going to really grow and evolve as trade. Right now, we're going through trade issues with Mexico. But in Monterrey, Mexico, they're building a ton of manufacturing plants, and that's all going to transit through San Antonio somewhere in the next 5 years. So there is always opportunity. You just have to look at those triggers that are ahead of all the competition. Because when the wave comes in, then it's much more difficult to get those deals. It's much more competition for the assets. They get bid up in price. And so it's looking for those sleepers, as you were saying, Brad, whether it's a Columbus or some of the other markets. And there are deals in every city. Again, I'm here in Phoenix. Somebody showed up. I talked to somebody yesterday, and they said, hey, what do you think of this deal here in Phoenix? And Phoenix is going to have a tough year ahead. There's a lot of completions coming, but that was a slam dunk. That deal was absolutely amazing. They're going to make a fortune on that. And so, again, even in a tough time, there are good deals to be made in real estate.
Yeah. So, John, I'm sorry I interrupted you. I want to make sure you have the chance to finish your presentation.
Sure. I'm going to jump through some of these. This is just rent growth by property class. Concessions are elevated right now. The market has been a little soft. There's always conversation about distress. Everybody talks about, hey, I want to buy all these buildings that are going to, have to be refinanced, and they can't afford the loans, and they're going to not be able to make their payments, and the bank's going to foreclose. Honestly, so here's the maturities of apartment buildings by year. Measured in dollars, and these are estimates from the Mortgage Bankers Association. There is some that got punted. We've had extend and pretend or extend and blend, basically as mortgages were coming due over the last couple of years, because it has been challenging and because the interest rates went up so quickly. A lot of banks were being very working with their good investors who made their payments and said, okay, we're going to extend this out for a couple of years, same terms, we'll hold on to this debt, and just keep making your payments, we'll work it out in the end. So we have seen some carryover into 2025 from 24, and some of that was punted from 23. But at the end of the day, the volume of lending and the amount of loans coming due is elevated, but I wouldn't characterize it as exceptionally high. And when you look at the delinquency rate, now delinquency means they missed a payment. Basically, they're at least 30 days late on their payments. And so this is by CMBS, Commercial Mortgage-Backed Securities, which is the one lender that tracks this very carefully. And so the CMBS delinquency rate for apartments is about 4.5%. Look back at 2011. It was up near 18%. It was, I think, 16% at the time. The delinquency rate is still very low. It's up. It's higher than it was a couple years ago, but it's still very low by historical standards. Retail is a little higher. Industrial is virtually none. Office is the highest, with about close to 10% delinquency rate. But again, even office properties, which have been kicked in the face over the last 5 years, still only have a delinquency rate about 10%. So that is still relatively low overall. So if the idea, and there's a ton of investors who plowed money into opportunity funds and said, yeah, we're going to buy up all these delinquent properties, we're going to buy these foreclosures, and they're still sitting there years later waiting for those deals to take place, and they're just not happening. There are some out there, and there are some deals that happen that are where a property owner just got out over their skis, they over levered, they used adjustable rate mortgages, they didn't have rate caps, they ran high risk model on purpose and got out too far, and they're going to be selling those properties at a discount. But that is not the standard. That's not the norm. There are some deals that happen like that, but that's not the standard that we're looking at right now. So I'm going to go through the transaction climate, what's happening with sales and prices very quickly here, and then we'll wrap up my section. When you look at the transaction activity, 2021 and 2022 were record years. They were off the charts. Basically, they were what I would call abnormal, right? 2020, because of the pandemic, was abnormally low. What I characterize as normal, it was 2014 to 2019. And compared to that, 2024 was about 17% below normal. I can't tell you what's going to happen in 2025. It's choppy and there's a lot of uncertainty, so it's hard to tell. But like Brad said earlier, when I was at the National Multi-Housing Conference earlier this year, where there were 10,000 different investors in the room, the consensus was that this is a year to get active, and that they were going to be putting out more capital and making more acquisitions. I also talked to a lot of those investors who plan to sell this year because the opportunity is right. They held on through the downturn, and now they're ready to make a move, release that capital and redeploy it into something that's going to be better suited to their growth strategies. One of the things I've seen many times is investors will buy an asset and they're so determined to hold that asset until it gets to their target return, and they make a mistake, because if you have one that's not doing well, you're better off getting rid of it and redeploying that capital into a winner. And so again, that was one of the things I know that a lot of investors are saying, hey, this is the year we're going to move out of these assets. We're going to move the capital into something else that we see as a better opportunity. When you look at the prices, they've recalibrated, they've come down, they're discounted a little bit. The cap rates, the yield on the multifamily properties have come up pretty significantly from where they were in 2022, which was, again, kind of the peak of the market. The cap rates, the interest rates were very low in 21 and 22. And so those cap rates were down around 4.5% on average. Now they're back up at 6%, much higher returns. But you also have to remember the cost of capital went up at the same time. So prices have discounted a little bit, but the fundamentals are there. Here's the same information for the different Texas markets, and you can see the cap rates in Austin and Dallas are below the average for the country. Houston and San Antonio are a little above the average for the country. You can see that price correction in Austin. As I mentioned, there was a overdevelopment there. And you've seen the prices come back down from a peak. Basically, in 2022, everybody wanted to be in Austin. I was hearing about cap rates, deals closing with a 3.5 cap, which is just astronomically low. But there was so much competition for assets and everybody wanted to get into Austin at the time that they were paying a premium, and it has since come back down again. So I always say, if you're familiar with me, I do a lot of videos, I have a podcast, and I have a lot of other things out there. You have to keep your eyes on the horizon. We get so focused on the news that's bombarding us today with tariffs, with taxes, with immigration, with just everything else that's coming at us, and it can scare the crap out of people. And so with real estate, you have to be focused on where you're going to be in 3 years and in 5 years. So you keep your eyes on the horizon. I'm going to close with this last slide. These are apartment cap rates since 1990. And when you think back, hey, what was the best year to buy real estate? 2008 was great. 94, 90, 2001 was a good year. And you have all of these years where you had a cap rate increase. They're actually very rare. We're in our fourth one in the last 35 years. Right now is one of the 4 times in history that cap rates have gone up. And inevitably, when you look back in time and you say, what were the best years to buy? Those were the peaks in the cap rates. And then you had a cap rate compression that drove values up and accelerated the returns. Now, are we at the peak today? I can't tell you. But it's gone up. And so if you catch it, you can't time it exactly unless you get very lucky. But if it's gone up, now might be a good time. So that's what I've got, Brad.
Hey, John, thank you so much. And I love this slide, by the way. I want to make sure that everybody gets a screenshot of this slide. And to me, this is like what really sums everything up. And this is why I'm really excited. Like when we look at these numbers and these cap rates, like it's a unique window of opportunity. And I'm just saying, like, look, this is my opinion, but just in a matter of months, people are going to start becoming more comfortable. Not people, yes, people, but also Wall Street, capital markets. Like what Trump is doing right now is creating a lot of uncertainty, but things are going to settle down. Like if you ever read his book, The Art of the Deal, that he wrote 20 or 30 years ago, which I've read this book multiple times, what he's doing now on the global level is exactly how he negotiates his deals. So to me, I think people are going to become more comfortable with what's going on. We're going to see that it's a lot of blustering and posturing. It's just my opinion. And I think things are going to settle down and we're going to have a few years of some really good buying opportunities that I haven't seen for look at what John was presenting. Like, I haven't seen buying opportunities like this for a while. So John, thank you. I'm going to have, I've already invited some of your investment sales team members and DFW to my upcoming event. And they're going to talk a little bit about what's happening in the DFW market and why DFW is arguably the first or second best market to invest in the country. And yeah, I'm just excited. So John, I want to do a screenshot of me and you actually smiling, if you're good with that. So on three, 1, 2, 3, amazing. I'll post that. And John, can I get a copy of your slides? Because we had like over 700 people registered, and we've had at a peak around 230 people online tonight. And I want to make sure that the people online get if it's okay with you, I would love to share your slide deck. So
happy to share with you.
Yeah. So my team will reach out to you, John, and your team. And for those of you that showed up tonight, as a bonus, I would love to share the slides with you. So we'll go ahead and do that. John, if you want to stay on, you can. I'm going to stay on for about another 15 minutes. And what I would like to do now, thank you, John. By the way, I would love everybody to drop in the chat something that John shared, a key takeaway, something you're excited about, some insight that you gained on something that John shared with you. So John, if you could at least stick around and see some of the chat, some of the comments. So a key insight, something you're excited about, or something that John shared that was, very informative. Besides Eric Burns, this has been great. Something specific. So we see 4 times in history, cap rates rising, multifamily is prime. Can you repeat what you said about San Antonio cap rates? There was a question, John, about the Fed, like Fannie Mae firings that I saw come in. Let's see, small changes in cap rates. John, you could see the comments, right?
Yeah.
Is there any, like, we won't address every single one of them because there's going to be a lot, but maybe just take a look at some of the comments and speak into some of the things that, people have experienced from your presentation.
I'm just scanning through here. What's going on with San Antonio? Essentially, look at the reshoring and nearshoring of manufacturing and how much of that's gone into Monterrey, Mexico. They transit up across the border by truck. This is a byproduct of what happened with supply chains with Asia. So they're moving manufacturing to Mexico, which is cost effective. This could be impacted by tariffs, but there's an opportunity there that will benefit San Antonio over the long term. Let's see, what else do we have? Brad, if you've seen anything that you saw that was a good question, happy to take it.
Well, let's see here. Do you know anything about what's happening with Fannie Mae?
A little bit. So the restructuring, the leadership. So first of all, they restructured the leadership, and second of all, they repealed some of the rules on housing, which was restrictive. The best information on this right now, because they're right at the tip of the spear, came out from the NMHC actually today. The Sharon Wilson-Janow, the president of the National Multi-Housing Council, put out a piece of information about the changes in the rules for Fannie Mae and she said it was very positive. And I know Sharon, she knows what she's talking about. So if she says it's good, she got me with that. So basically, they're reducing restrictions that were being put in place on lending that were tied to the different social programs. So that will make financing easier. They're also looking at privatization of Fannie Mae and Freddie Mac. That is something that would take a fair amount of time. So I wouldn't, again, it's one of those things where I'm like, it's not going to affect my financing this year, so I'm not going to worry about it right now. And it's still a big maybe. So that's what I know about what's going on with Fannie Mae right now.
Awesome. Well, hey, I know we're slightly behind schedule. And so John, you've been here longer than I asked you to be. So thank you. And for everybody out there, I'm going to spend about 15 more minutes talking a little bit about the top markets for 2025. And John, I've used your company's report and a few others. So I'll be sharing the top markets for 2025 and why DFW, Austin, and Houston is in the top 10. So if everybody that's still on, we'll stay on for about 15 minutes and then we'll wrap up. So thank you, John. And so what I'd like to do now, let me go back to my slide deck and see where we're at here. Hold on. Oh, that was not the right presentation. You think I would know how to do that at this point? Let's see. Okay, so where we're at. Okay, so here's where we're at. So I did my introduction. I talked about why I'm optimistic. I talked a little bit about rat race, and I want to talk a little bit more just for a few minutes about top markets and share with you some data that I got mostly from John Chang's team on why DFW is one of the top markets. Before I go into that data, I'd like to just call on, if you're still here, I have a few people online that I just noticed that have been to my rat race event. And so I'd like to pull up Arun, Demetria, Sharon Riddle, and Casey. And let's just all come on the same time as a panel. And I guess, yeah, let's see if we could get them all at the same time. So we got Arun. Arun's from North Carolina. Casey is from North Dakota. Sharon is from Dallas, and Demetria is from Dallas. And I'd like for each of you, just for 1 minute, because we're running behind, to just share, like, you guys are also part of the Sumrok community. Okay, and you've been involved in the Sumrok community for many, many years and have many, many deals under your belt. But what I want to ask you tonight is to talk about the experience you had coming to the rat race event. Not, your all the deals you own and all the money you've made and all the people you helped. But at one point in time, you heard me speak. Maybe you were on a Zoom meeting just like this. And I was talking about rat race to retirement, and you came to that event. And so what would you say about your experience? So, Casey, I'll start with you.
Yeah, well, so I had a dentist friend actually tell me, hey, we should go check out this guy named Brad Sumrok down in Dallas, Texas. And so we flew down there, we were hanging out, and I'd already owned a bunch of real estate. And I'm sitting there in the kind of the back of the room or the middle of the room or whatever, and I'm watching all of his slides, and I'm sitting there just thinking the whole time, like, man, Brad is he's a guy that does deals just like me, you know what I mean, and adds a ton of value to properties. And I remember going down for the R to R, and I came back with one thing, Brad, which was I learned how to install or do water conservation from attending that rat race to retirement. And I came back and I think I ended up doing like 12 water conservation projects on all of my properties. And it was like 400 toilets. It was, I mean, it's just massive. I think my cash flow from that alone was like $4 or $5 grand a month.
So you invested a weekend to come to Dallas, a couple $100, and got
Yeah.
a four or 5,000 a month ROI.
Yeah,
Thank you for sharing that, Casey.
for sure.
Sharon, what about you? I remember you and Dan have been part of our Sumrok community for a decade, but what was your experience like at the Rat Race event?
Well, we were totally amazed because we had been given a promo code from Dennis Henson back in 2015. And so we came to the Rat Race retirement and it exceeded our expectation. And we immediately joined your community because I was self-managing our single family portfolio and we weren't able to scale it in the way we wanted to. And so we immediately found some general partners that we could invest with, that we could vet. And yeah, we were investing that first year, and then we upgraded to personal mentoring that first year. So it exceeded our expectation truly, and has for a decade now.
Thank you.
You're
And
welcome.
Demetria, you're I remember when you came to Rat Race, it's, you know, share with everybody your experience of coming to the event. You live in Dallas and the event was in Dallas.
Yes.
So what was your experience?
So I'd heard about your mentoring program and bus tours and all these great things from a coworker. He's also an engineer. I'm an engineer, and ended up coming to the Rat Race, not really with the intent to join as a mentoring student. I just wanted to learn how to scale up and to do things much bigger, quicker. Me and my husband both had already done real estate on our own. We had owned single family homes and 128 unit, and it was the hard way. And so we ended up selling our entire portfolio in 2021, but we were looking for a way to just go bigger. And when I attended the R2R, it was just the perfect fit. And I looked at my husband and I said, it's time. And so we joined the program. We haven't looked back. We ended up becoming general partners within 6 months of being in the program. And we have held that property just a little over a year now. And so we are trucking along and can't wait to be able to sell that to double our money for our investors. And so we just had a great experience, a great ride. And I would recommend the mentoring program to anyone, or just coming to R2R, which is where it all started.
Yeah, look, everybody, the next step, if you like what you heard tonight and you're excited about the opportunity that I shared with you, that John shared with you, look, I'm an engineer with an MBA. John's a research scientist. The facts are pretty clear. We have a window of opportunity to get into this business and to really, you know, I don't want to say take advantage, but to leverage what's happening in our country. And I never advocate trying to time investments and time the market, but I also advocate trying to understand patterns and data. And so I always tell my mentees, like, don't try to time the market, but we got to understand it. And so I just see a window of opportunity here that I haven't seen in over a decade. And this is why I'm excited. And so, Arun, I'm going to ask you to speak about your experience too, but is the screen being shared? Could you guys see the QR code for with the event dates up there? Sharon and Arun, is that?
Yep, we can see it.
Because I can't tell what I'm sharing right now. I have multiple windows open on my 13-inch MacBook. But look, the event that's happening in April in Dallas, I'm going to teach the exact system that I use to find deals, analyze deals, fund deals, close deals, and manage deals and exit deals. over a 2.5-day period. And so if you're interested in learning the business, this is the next step. Okay. So Arun, you're in North Carolina, which is also one of the top markets, by the way. And you came to Rat Race years ago. You and I actually co-GP'd a deal together. But what was your experience at the Rat Race event?
Absolutely. Thank you, Brad. I was actually in New Jersey at that time. This was 2017, working for JP Morgan, but I was doing single family flips and always wanted to get into the larger multifamily space, but didn't know how to. So I heard about the Rat Race through, I believe, Raj Kuntnur or a few of other Sumrok students. I said, what the heck, hey, it could be another event that I just go on, spend a weekend with. I was just blown away with all that you taught there, and even the community. Anybody I spoke to had very nice things to say. They were always sharing. And they said, "Hey, reach out for any help," or it was very, very eye-opening, and I immediately joined the mentoring program. Even to this day, I remember all of my money was in flips. I didn't even have the money at that time, complete money to join the program. I did. It's just been a blessing. All around. So,
well, thank you. So, look, I didn't know you guys were going to be on tonight. I didn't prepare you to come on. When John was speaking, it occurred to me that I wanted to talk about the Rat Race event, and I just randomly saw 4 people that are in my community, and I knew that have been at the event. So, thank you all for sharing your experience. And I'd love to talk about a little bit for 5 minutes about the Dallas market. So I know some people dropped off, but for those of you that stayed, we're going to cover the Dallas market now. So, hey, thanks, Casey, Sharon, Demetria, and Arun. Thanks for sharing your experience. So make sure if you're watching this live, they're recording. We have a limited number. Look, you can buy the ticket the day before the event. And as long as there's a seat available, we'll accommodate you, but you're going to pay more. Okay. So right now we have early bird pricing, and you'll be able to come at the best possible pricing. And as I'm speaking, there are people buying tickets. So before the Zoom meeting, we had 17 tickets left at the early bird pricing, and then it was down to 12, and my team just texted me and it's down to 10. So if you know you want to come, I just want to encourage you to get the early bird pricing. When you go to the, let me see where I wanted to share this. My screen messed up here. When you go to, when you click on that, you'll see this. You'll see the platinum ticket at $297, and you'll see all the things that are included with the platinum. The platinum ticket, you're going to get better seating. You're going to have a lunch with me and the industry experts and a few of the other speakers. And we'll have a dinner one night just with the platinums. GA is still an amazing experience. And, but if you want more time with me, more time with the speakers, better seat and better food, you want to upgrade to the platinum experience. And there's your QR code. And let me go into this market data here on Dallas now, and then we'll wrap up. So let's see, I'm jockeying presentations around here. Yeah, so look, I've been doing this 22 years, and I've learned a thing or two about what makes a market really good. So all markets are not equal. And one of the things that's absolutely necessary right now is that you need to invest in one of the top markets in the country. Now, when I say right now, between 2012 and 2022, there were so many tailwinds that you could have been average in the business, made average decisions, and invested in an average market, and you could have had above average results. And now we're in a season where you need to invest only in top markets, and you need to surround yourself with amazing people, industry experts, mentors, education. And if you do that, you could get extraordinary results. And if you don't do it, you could have poor results. So what I've learned over 23 years now of doing this business is that there's certain things that I look for in what makes a great market. So one of them is we need to be in a landlord and business friendly environment. Okay. Not to be political, but at the state level, I look at, just to make it simple, on the political map, is it a red state or a blue state? So I prefer to invest in red states at the state government level, or at the level of like, did it go red or did it go blue? Because generally speaking, these states are going to have laws and policies that at least give us a fair chance. And when I say give us a fair chance, imagine you own a restaurant, okay? And I'm going to speak to all the people now that may not be with me in terms of red and blue. But imagine you go to a restaurant and you order breakfast, and the customer doesn't pay. Okay, well, they don't pay. You'll probably ask them to leave, and they would leave. And it occurs to me, I don't know the laws about that, but it occurs to me the laws would support that restaurant owner. But instead, imagine that they don't have to leave and they get to order lunch and they get to order dinner. And you have to continue to provide them that service. Well, there are certain cities or in states, in municipalities, that's how they treat housing. You don't have to pay, but you could still live there for free for a long period of time. So I want to invest, and I would encourage you to invest in areas where if they don't pay for the product, they don't get to consume the product in the future. I also love to look at job growth, population growth, and affordability gap are three of the main economic drivers that determine how multifamily investments perform. I also look at the new supply coming online, but not just the absolute number of units, but the number of units compared to the total inventory. And then I never, ever want to invest in a location that has like an undiversified economy. So if you're investing in a tertiary market and a large percentage of people work at the university or the automotive plant or the military base, you're taking on additional risk. So if you follow this recipe, in general, you're going to have higher returns and lower risk. So the top markets for 2025, based on all these factors, based on the Marcus Millichap reports, the Berkadia reports, the RealPage reports, the CoStar reports, all the industry experts that I follow and read and study, these are the top 7 regions that have the best multifamily performance. South Florida is on fire. Miami, Fort Lauderdale, West Palm Beach is on fire. Dallas, Houston, and Austin is on fire, and arguably San Antonio, the Texas Triangle. Central Florida is on fire. Orlando, Tampa, St. Petersburg. Las Vegas is a great market. Phoenix is a great market. Salt Lake City is a great market. And the Raleigh, Charlotte corridor of North Carolina is a great market, and arguably Nashville, Tennessee. So these are the top main markets. And also pay attention to the tertiary markets near these larger metropolitan areas. Okay. So I'm not saying like not to invest in Columbus, Ohio, or Indianapolis or Des Moines, Iowa, because some of these markets are really good too. But when I look nationally, these are the top performing markets based on job growth, population growth, cap rate, landlord and business friendly, and affordability gap, and new supply coming on as a percentage of total inventory. So why am I excited about DFW? Well, this is directly pulled from Marcus Millichap's 2025 report. They have DFW as the number 2 market out of 50. They studied the top 50 metropolitan areas. DFW is number 2. You can see NMI rank. I don't even know. I could tell you what NMI stands for, but it's the Marcus Millichap acronym for the top 50 markets, and it's number 2. So it reads at the top 10 market for employment, for household growth. We see employment going up 1.9%. It's going to lead the nation in hiring, which is a huge thing that we look at. We see construction is down, which is also good because the less construction that's happening, the more demand there's going to be for existing multifamily properties. And by the way, in 2025 and 2026, the construction is going to be down even more. And the population growth is booming in DFW. We could see vacancy going up a little bit right now because there's still new supply coming on, but that's going to shift. So the vacancy is actually going to change directions, and we're going to see occupancy growing in 2025 and 2026 and 2027. And then rent growth is at a healthy 2.2%. And this is organic rent growth without doing any value add whatsoever. I think John may have showed some of these. Maybe it was at the state level. But again, we could see employment trends with total employment in year-over-year percent change in the upper left. We could see supply and demand with completion and absorptions and vacancy rate in the lower left. We can see rent trends in the upper right with the average rent. And we could see the year-over-year change is in the positive direction. And most exciting to me is in the lower right, we could see the price per unit is down and the cap rate is up. And I don't believe that trend is going to continue. So again, I think we have a window of opportunity in DFW where we could be buying deals at like pre-2021 pricing and get into really good deals at a great basis. So I think that's about all the data that I have for DFW. If you guys want to take a screenshot of that. And again, just as a reminder, the last reminder before we call it a night is consider attending the Rat Race event. If my teaching style resonates with you, if the information we presented tonight resonates with you, if it occurs to you like it does to me, that there's a window of opportunity from what I shared with you, from what John shared with you, and what's happening with the taxes, where apartments are once again going to be the best asset class for tax advantages, consider attending this event and you won't regret it. So I'm going to wrap up. I apologize for being a little behind schedule. For those watching tonight, I want to thank you for tuning in live. And for those watching the recording, I want to thank you for making it to the end this far. You are in the minority of the people out there. So I want to thank you, and I appreciate you.